only reason why you would want to have it written and you would want to have it registered is because if there is a dispute and you want the dispute to be adjudicated in a court of law, you would need a registered.
And co-ownership is more primitive than firm.
Yes, yes. Co-ownership, the best way of understanding co-ownership is to think in terms of husband and wife. That's the ideal way. Although there is a slight distinction even there. I don't know whether I showed that, included that part in one of the earlier lectures of joint tenancy and co-ownership. I don't want it to become too legal, too technical and confuse you people. So the best way of figuring it out is husband and wife, co-ownership.
One more question.
Sure.
Is proprietor, that's the owner itself?
Proprietor is sole proprietor. Single. So in fact, these advantages and disadvantages, they've been formed. In the earlier presentation, when I talked about advantages and disadvantages of a partnership, it was with reference to a sole proprietorship.
So what about the association?
See, association as in apartment owners association.
Yeah.
See, there are two types of associations there. The first question would be, what kind of an association? Is it a registered association or an unregistered association? You can have a registered association also through a deed, in which case everybody is an equal. The only reason why you are coming together is either you have some common interest that you share, which in case of an apartment complex is maintenance of the apartment complex. So everybody has a common set of rights and duties. But anytime you have a partnership, think in terms of, let's say, one ophthalmologist, one internist, 5 doctors get together and they say, let's have a hospital and we will have a partnership. So in that case, each person has his own field of specialization that he brings, which is not the case in case of apartment owners. Everybody is an equal. Although even in a partnership, all partners are equal, the special skills that they bring to the table will be different. And to that extent, their duties, their rights, their privileges, their responsibilities, all that will also change. Not so in case of an apartment. So, the way statute works in case of an apartment ownership scenario is, if it is unregistered, then of course all apartment owners, they come together, formed an informal association for maintaining the property. Now, if it is a formal association, then it has to be put in place through a deed of declaration. There is a special act for apartments known as Karnataka Apartment Ownership Act. So under that act, you will execute, all apartment owners will jointly execute a deed of declaration, and then they would get covered by statute. So that statute will make provisions for who does what, who's responsible, how will the office bearers be elected, how will the office bearers operate, how many office bearers will be there in the managing committee, all those things will be there. Some of it is covered by statute. And then on top of that, in the deed of declaration, you would also put in whatever you want to be included, whatever manner in which you want the association to be run.
And unregistered society, that also has...
See, unregistered society, the worst problem is, anything that is unregistered, it becomes a very difficult problem trying to have it enforced in a court of law.
So legally it's sort of invalid or something? Or
it's not, no, it's not that it is legally invalid. It is legally valid. Only thing is, if there is a dispute...
So how to solve it?
Basically through negotiations. Many of these apartment complexes, it's a major hassle. Somebody will say, no, I won't pay for light.
Major hassle. In fact, people are not ready to get it registered.
No, I know. That's the problem.
Even though they get registered, they will not get registered to Karnataka owners apartment.
Yeah. Societies.
Some other act.
Societies. Karnataka Societies Registration Act, which is not valid. It is not valid because it's a standard principle in law that any time there is a special act, see, the Societies Act is a general act. Any society in general, regardless of what that society is going to be doing, can be registered under the Societies Act. Whereas the Apartment Ownership Act is a special act.
So it has to be registered as special.
Not registered, it has to be through an automatic registration through deed of declaration.
Okay, that's fine.
So the statute provides for it. So once you execute the deed of declaration and it is registered at the sub-registrar's office. So that way the registration is with the sub-registrar's office. Whereas in societies it is with registrar of societies. So the two are different. So the sub-registrar, once he registers it, you are a valid association, registered association.
So if any apartment so they register under society registrar, it's general, so it's not a valid.
Not that it is not valid. See, sometimes what happens is there is also issues like customary, how you've continued running the affairs. It has a quasi-judicial status in the sense the memorandum of association of a society or an apartment owners association is kind of like a constitution for that complex. So courts normally don't get involved in the affairs until and unless there is some major wrongs that have been committed. So if let's say I am an owner and some of my rights are being infringed upon, then courts will get involved provided the association is doing nothing to remedy my wrongs. So it's a little technical in the sense there can't be a standard answer for it until and unless the facts and circumstances are fully known. But by and large, the way it would have to work is if you formed a society, that society has to be shut down, terminated, and through the deed of declaration you would get covered under Apartment Ownership Act. So what you would do is before you wind down the society, you would have the deed of declaration executed, and then once the deed of declaration is in place, you are covered by Apartment Ownership Act, so you close down the society. That's the way it will work. See, because for a society you have to do annual filings. As part of that filing you have to pay some fees, some 1% of total money that you've, revenues that you've generated, all that, which is not there in Apartment Ownership Act. You need to get the books audited, but there is no concept of filing and
So which is good for apartment owners?
Apartment Ownership Act.
Okay.
By default.
So then why people do not go for that? It's a politics thing or?
No. Awareness is not there. See,
no,
I think it requires a lot of documents like complete certificate, tax certificate, which
Yeah.
a lot of things.
Yeah. All that will have to be there. See, ideally, the way it is supposed to work is, as per the Act, if I remember right, the moment the builder has sold 6 units, he can have any number of units. He can have either, let's say, 10 units. The moment he touches 6 units and he has 6 owners for those units, the balance 4 units, he will show under his own name. Because it is, at that point in time, he is the owner of those balance 4 units. He will describe the property in great detail and then execute the deed of declaration. That's the way it is supposed to come into being. No builder does this. They will always go through a society's route because the moment you have the deed of declaration executed, the builder loses right over the common areas. Whereas in a Societies Act, he retains his right and title over the common areas. Now, I don't know whether builders calculatedly or deliberately or intentionally do this, but if you are doing it as a society, your builder has a right over your complex.
This happened with the L&T.
I know. My senior Anantram is the counsel for L&T, not the owners association.
It was the park area or something.
No, that is encroachment.
Oh,
that is fine. No, but it is being litigated.
Sometimes builders know if they are got a permission of G+3, they consider G+6. That time they will not get this
occupancy. See, all sorts of fraud goes on, cheating, fraud. Yeah, because they have to declare what exists accurately and they are worried. So whereas in a Societies Act, they just say there are so many units, they don't have to declare floor spaces, built up area, super built up area, all that. They just say these are the owners, this is the door number, apartment number, and these are the members. They don't even need to do that. Some 6 people on behalf of the association can go and form the association under Register of Societies Act.
So, instead of doing this bidder deed of declaration, for 7-8 members they can come together in the apartment and they can form a deed of declaration.
No, everybody would be needed.
That is exactly my question. So you need everybody.
Everybody, which is a big hassle. So that is why it is said under the Act, see, the people who who go through the legislative writing process for enactments, for such statutory enactments, they are very intelligent people. So they realize there may be scenarios where an apartment complex may have 1,000 apartments. Can 1,000 people show up together in I mean, the office, the sub-registrar's office will go crazy. So they said, the moment 6 owners are there, the builder has to get the deed of declaration signed. So what he will do, if there are 1,000 apartments, 6 owners he will get, physical, who will put with their faces, with their thumb impressions, all that. And then remember the remaining 994, the builder. He is the owner. So he just puts one signature and one thumb impression.
So this is under the Apartment Act.
Apartment Act. Whereas under the Societies Act, that's not the case.
So Apartment Act is, you said, good for the owners.
Good, yeah.
I mean, it has happened the other way around for us.
Yeah, because everybody goes, that's what I was saying, in the Societies Act, the builder continues to have a right on common areas. See, if you are under a society, who owns the common areas?
Society. It's one.
Because the society association.
Real owners, association.
Either that, because many of these builders, at least in Bangalore, I know, they will not put the super built up area. That is the first thing that you need to check out. There are many reasons why they don't put up the super built up area. One of the reasons why they don't put the super built up area is if there are 10 owners, 10 apartments. I add up all super built up area, I should get the approved sanction plant area. There would always be violations. So that's one reason why they don't put up super built up areas. So the sale date they will execute is built up area. So if you add up the built up area, the built up area will be less than the sanction plan super built up area. So who owns the balance? Builder. Because he's still not alienated it. See, there are a lot of technical issues here. You need to be very careful. These are the things that builders use.
Even builders, what they do, they also treat BHK, but permission that they want BHK.
Common, very common.
If you say that super built up area belongs to the owner,
No, not the super built up area. The common, share of common, yeah, common area.
Maybe later some stage, that area becomes very dense population and this guy feels like, okay, if we build some shops there, can you do that?
Of course he can. Of course he can. Because he still has a right over the property. See, all these things, I'm sure, see what happens is you and I as buyers, we go as individuals. That guy is a businessman. The way the market works, he will have a legal advisor. He won't pay the legal advisor cash. He'll say one
flat.
That is his fees.
One flat.
Well, police and all, even my customers, like downstairs, all one police guy stays, upstairs the bidder stays, and when we went and asked why upstairs you are constructing, means terrace you are constructing this, you go and check your sale date, it is written, there is no terrace belongs to bidder.
It's very common.
Very common.
There is swimming pool, that pool, this pool, maybe if the area gets commercialized, they can just build somewhere.
Sure, I think that is how Brigade Millennium, ideally, I won't be surprised if that clubhouse of Brigade Millennium was positioned as a club, exclusive club for the society, for the owners. They've thrown it open. They collect 3 lakhs, 4 lakhs, 5 lakhs for membership.
What happened?
Brigade Millennium.
Yes. So they collect 3 lakhs.
3 lakhs or whatever for membership.
Yes.
Originally, when the whole project came up, I'm sure they would have sold it saying this is exclusive, huge clubhouse for owners with gym, with swimming pool, with this, that facility. builder has realized this is a money spinning racket and he has right over it. What can you do? You can't do anything. You want to go to a court of law? Sure, go to a court of law. 15 years. See, this is what people unfortunately.
So that MS means always it's a firm. It's a
Which one? Messrs.
Yeah.
Messrs always is a firm.
firm.
By default. So common seal, a company exists with a common seal. Although it does not physically exist, this is what is in legal terminology we say legal fiction. So the company is also a legal fiction in the sense you have given it personality. It is like it has a legal existence, but physically it does not exist. I mean, there is no physical persona for that company. Understood? Or is it very vague? If it is very vague, I will explain it a little more. Clear? Limited liability, we talked about it. So you can sue and you can also be sued. Whereas in case of a partnership, all partners would have to be a party to the suit. So if it is a partnership and I have to sue the partnership, I will name the partnership and I will also name all partners of the partnership. Very important.
In this proprietorship, it means always sole proprietorship.
Sole, always sole. There is no multiple.
No, I've seen
proprietors.
people writing as proprietors and no.
Must be a family-run affair.
Okay.
So a sole proprietorship is a sole proprietorship. They may have even formed it as a partnership. So they are saying proprietors as in owners. They may be using it as a synonym for owners.
Okay.
That is possible. Because they have a proprietary interest. The family members have a proprietary, which means basically exclusive interest over the business.
So in that case, they become co-owners.
Co-owners. Co-owners.
What is that family business like S.C. Johnson? The company always they will put family.
See, it is a, first of all, S.C. Johnson, is it an Indian company or Swiss? US firm. So see, in the US, you have a clear distinction between privately held and publicly held. Publicly held, which is also there here. If it is privately held and if all shares are within the family, then I think they will say family owned. Like for example, most of the publishing houses are family owned. Forbes, the magazine Forbes itself is a privately started also.
So they all follow this form.
They would all be firm. See, the US is a little different because US has many more things. It has S Corp, C Corp, LLP, LLC. So it has a bunch of things. LLP does not exist here at all. It is limited liability company. Limited liability partnership. There you have limited liability. LLC is different from corporation. Because in India, the taxation is there is one uniform method for taxation. There they have multiple methods for taxation. So what they do is, like for example, if it is an S Corp, although you think it is a corporation and you incorporate it, the taxes, the profits are not taxed to the corporate level. Whatever you distribute amongst the owners, that gets treated as an income and it gets taxed as an income tax. Here it is not so. Even if it is a firm, the net earnings of the firm will be taxed and whatever salary you draw, taxed. Whatever profits you take, taxed. So a little different.
Private limited, you said cap is 200.
200.
What about LLPs?
I don't remember the exact number. I wouldn't be surprised if it is not more than 50.
Okay.
But I will check it out and I will get back.
You said there is no LLC in India.
No LLC in India. LLP exists. LLC is a private limited company, you call it. Although there you have an LLC, you have a... Although in India there are a few other special things that are applicable to India which I'll come next. It's there in the next slide. There is a single person company in India. Then you have producer companies, which is unique for India.
What is it, some company, say for example, Bellow and
Which one?
Brothers company, something, Bro and company, something there.
Give me an example.
Adco.
Huh?
AP Adco, KT Adco.
And co will be there.
And co, okay. No, it basically means it's a partnership. And co-owners. Yeah, co-owners.
And
No, yeah, because if it is private limited, you have to necessarily by statute include in the name private limited company. Limited company, within brackets private, whichever way you want you can put it.
Yeah, as he said, that is not Karnataka one car dealers, big car dealers. They make them Bellad and Company.
And company.
So,
Yeah.
It would typically be a partnership. Worst case scenario, it would be completely family owned.
Okay.
It is not a public limited
Oh,
company.
it's not a private limited.
Sorry, it can't be a public limited for sure, and it is neither is it a private limited company. So let's look at the disadvantages. So the advantages are basically, they map onto the disadvantages. We said the firm is a flexible organization. Why? Because it's very easy to form. All that you need is you execute a deal and you are done. You are ready as a partnership. Regardless of whether you get the firm registered or not, because registration is optional for a firm. Whereas for a company, it is mandatory. And although the formation is inflexible, there are certain inherent advantages with a company. Because by virtue of the company being limited liability, what goes on within the company is transparent. The external world is transparent to it. In the sense, if the company is run poorly and the company becomes bankrupt, you can't hold the shareholders and the directors personally liable. Although the company has done poorly and has gone bankrupt because of the actions of the directors on the board. Unless there is a clear case of fraud, dishonesty, which is basically criminal in nature, in which case courts will look into the internal workings of the company. So, when was this decision taken? How was this decision taken? Who took the decision? Who were the board directors on board who were present in the meeting? How did voting take place? So, there are a lot of restrictions. Procedurally also, company has that overhead of procedure. Company, I said, is not a citizen, although it is a juristic entity. It does not have fundamental rights. Whereas in case of a partnership is nothing but partners taken together. So those partners have their fundamental rights. Elaborate formation procedures. I've re-put the whole thing. It's just work differently. Creation, registration is must for company. Legal existence, it has a distinct legal status. Liability, it is limited for company. Shares can be transferred from owners to owners in case of a company, not partnership. Property, the property of the firm belongs to all its members, whereas property of a company belongs only to the company and indirectly to the owners of the company. It's indirect. And when you look at it indirectly, it will always be net of liability, because if property is an asset, it is own net of liability. Agents, that is not the case for companies. Members of companies, shareholders of companies are not agents. I mentioned this also, contracts. Members of a company cannot enter into a contract directly with the company. I can have an employment agreement in case of a partnership. In case of a partnership, I cannot have an employment agreement, but in case of a company, because there is a extra entity being created, that entity can enter into a contract with, like for example, a managing director can have a contract with the company, which is his employment contract.
But the conflict of interest has to be considered.
No, that's the key thing. There is no conflict of interest because the individual status is different from the corporate status. The two exist separately, but they are related. In fact, as part of the procedure, if at the time of incorporation of the company wants to enter into a particular contract with say, let's say the managing director or the promoter, that also needs to be filed with the registrar of companies. So there are procedures there, which is not so. A partner will be barred from entering into a contractual relationship with the firm. Audit, mandatory for company, optional for a partnership firm. Although partnership firms also get audited. Dissolution, anytime a firm wants to dissolve, they can dissolve. Company, there is a elaborate procedure. What
is the ticklish question? To dissolve a company, which is a major hurdle. Why it is
See, major hurdle is debts that the company. So what happens is any person who's owed money, he has a right. In fact, under Companies Act, all suppliers, all debtors can get together and force dissolution of the company. So company, limited liability is a very attractive
Still, if
thing.
it doesn't meet their whatever debt.
No, that's a risk that they're taking, but at least that is better than not getting paid.
Okay.
And maybe the fact that you are forcing dissolution of the company or threatening dissolution
That
of the
itself
company,
may
make the person pay.
basically debt factor.
Debt.
But as you said, personal wealth is intact here.
Personal wealth is intact.
Unless fraud.
Then they will come after personal. Like Ram Lingaraj, they have attached his property. See,
And Malia has not reached that state.
he's not reached that stage yet because, see, whatever collateral he had provided to SBI and to these banks, they have taken over, they have encashed it. His personal wealth, I think.
But they don't have, in Mumbai has some his own
Apartments, but all collateral. He would have given it as collateral. So anything that he has given as collateral is gone.
Okay.
If I have not given anything as collateral, they can't come after my personal wealth. See, there are multiple ways in which you would look at types of companies. The first one is pretty commonsensical: holding, basis of control, holding company, subsidiary company. Because even a company can become an investor in another company, or a company can promote another company. So a subsidiary is fully or partly owned. Basis of ownership. So either it is a government, it can be a government company. So if it is a government, it is promoted by government, either exclusively by central or exclusively by one or more states, or jointly by center and one or more states. So three different scenarios you will have. Non-government is basically a private/public company. In the sense, all companies, even public limited companies, initially get floated as or promoted as private limited company. And then they get taken public through a public issue. Foreign companies, even a foreign company can have a branch. It can either have a branch office, there are three things that RBI permits. Either you can have a representative office, or you can have a branch office. Representative office is not supposed to transact business. It is there for gathering information, getting to know what is going on, studying the market, understanding the market, or working as a licensing office. Branch office can have trade relations, but still it's a branch office of a parent that has been incorporated in some other country. The moment they say we are going to have a local presence, a subsidiary in India, that subsidiary has to be promoted under the Companies Act. So that would be a foreign company, because the holding is foreign. Whereas in a private or public limited company in India, the holding is completely Indian.
This recent Uber case.
Uber.
So it is not having
US, yeah.
Okay. So it was operating here. I'm an aggregator. They don't have any branch or something. Few people they are operating it from their apartment or something. So what case is it?
See, they would anyway it is a criminal case. So in Uber case, pinning criminal culpability on the company would be difficult. So what has been done is that lady, it so happened, was a resident of the US. So she has sued Uber in the US. I don't know whether you are aware of it, it was there in the newspapers.
Yes.
She sued
in US.
In the US. So there they will end up spending a fortune.
Right.
Here they are going to get away lightly. Although the drivers, some of them may get pinned.
But actually, like he's telling I'm an aggregator, whatever happens is the transaction, everything goes to them all the profit and all. So whatever has to be paid, they just pay them as
See, there are a lot of loopholes like this of this kind, because even after so many years of becoming a leader in IT, our IT laws are very poor, very weak. Our data protection laws, our data privacy laws, all these are very, very weak and very flimsy. So they can all get away very easily with it.
They have to register as a private company.
Who? Uber?
They are not registered.
They are not, that is what he is saying.
They are not registered.
They are not registered. So,
they are telling you that we have just provided this service.
see, but it's a criminal case. So in criminal case, the person who has perpetrated the crime, the offense, the offender, he would be prosecuted by the state. It is very difficult to claim damages, to treat it as a civil case for many reasons. The way civil suits go on in India is very different from the way civil suits go on in the US. In the US, a big thing is penal liability. Here, damages are actually estimated. If let's say the lady was raped and she had to undergo expenses on her medical treatment. So the funny thing about laws here is there will be coverage for her, maybe loss of salary, loss of pay, all that. They will calculate the actual financial loss that she has incurred and they will cover the loss. Whereas a penal provision is what you make force the company to pay as a deterrent. That does not exist. Courts don't, like for example in the US, if something like this had happened, Uber would have gone bankrupt. A company that small, because they would have said $100 million as penal damages.
In fact, the other way around here. If you move the court, probably your damage is mitigated.
Mitigated. Yeah, because you also have to spend that much more money, and you may spend a fortune on your legal counsel, because what you end up paying fees and things like that, it costs a bomb. But the court still says, per hour, per appearance, 500 rupees to the lawyer, to the advocate. Whereas you may have actually paid 50,000, who knows, depending on the lawyer that you have hired.
Also it is banned, so government is banned that you in Delhi, but they are questioning why it is banned.
Who, Uber is questioning? Or the banks that have lent
Others
money?
are like, why if someone is happening this thing, why
Why is the company being
banned?
banned? No, they also have a valid point, because the company didn't tell this guy. See, the only time when the company also becomes liable is if there were other instances when there were complaints received of the same driver and they did nothing. It's the same laws that apply for sexual harassment in the workplace. Anytime a lady, it is to the point that if you have your monitor and people around you are ladies, you can't, even on the phone, make obscene comments. You can't have some crazy pictures and photos on your computer. All that would be treated sexual harassment.
Code of ethics.
Code of ethics.
President missed it here.
One second, let me just do 1 hour and then. Yeah. Which one?
Difference between holding company and
Holding company is the parent company. A company can promote another company.
Okay.
So the company that promotes one more company is the holding company. The company that gets promoted is the subsidiary.
Okay.
So the subsidiary can be partly owned or wholly owned.
Right.
If that holding company puts the entire money, it becomes fully owned subsidiary.
Okay.
If the holding company with another holding company or as a joint venture,
So partly owned.
Subsidiary.
If Chennai Holdings company formed one more thing.
They can form, if it is an international company, then it is a joint venture. If it is 2 Indian companies, then it is partly owned subsidiary of both Indian companies.
So if it is one of them is a foreign, it becomes joint.
Joint venture, typically. So 2 corporate entities of 2 different countries, they join hands to form a company, which is a joint venture.
Otherwise, I mean, so joint venture is specific.
Specifically, so if you use, see, people will loosely say joint venture.
I know.
But from a legal standpoint or even a financial standpoint, if you say joint venture to a lawyer, he will understand it as,
And then the INC stands for incorporated.
Incorporated, that's a US company.
Joint venture is partnership.
No, joint venture means there are two investors, two companies that have invested. One company, maybe a company promoted in India, formed under Companies Act, and similarly the other partner is a company, you can jointly loosely call it a Indo-US partnership company.
And regarding this NGOs, suppose if
Non-government.
if any person want to open the NGO, it can be single owner or it can be
No, it is not in that sense. It is not an NGO in that not-for-profit sense. This is a non-government owner of the company, which means it is private sector.
Okay.
So this is public sector, like BEL. See, government companies are formed in two different ways. Here we are talking Companies Act. If it is formed under Companies Act, it would be a government company. Some of these companies are formed through an Act of Parliament. They are statutory companies. They are different. Because they are formed by statute, which means Parliament enacts a special act that brings this company, maybe let's say, is there an MTNL Act? I don't know. I don't think there is an MTNL Act. So typically, like for example, LIC of India Act. LIC of India has been set up through that enactment of Parliament. So that's a different kind of government company. It's a special act of Parliament that has brought that company into existence. These companies are brought under the Companies Act or brought into being by incorporating it under Companies Act. That's the difference. Similarly, non-government would typically mean private sector. So public sector, private sector, foreign company, which we
all simple thing, the owner will be President of India.
President of India. Nominal owner. Basically, by name, he would be the owner because all business gets transacted in his name. Doordarshan may not be a corporate entity.
But I heard it. In reference to Doordarshan, I think I heard that Doordarshan Act.
Yeah, no, there could be an act, but you have to see whether it has been incorporated as a body corporate. I mean, there is many of these concepts. I don't want to confuse.
Anything happens, like in news or whatever it is, it's directly reporting to President of India.
President. No, see, the key thing here is there is also a concept called body corporate. I don't want to bring in too many of these complications because they are all with reference to the way government entities like a SEBI is a body corporate. It has been brought into place through an act of Parliament. It has a separate seal of its own. It can own property, sell property, buy property in its own name. So SEBI can own a whole huge building. It can sue and it can be sued. It is distinct from government. It's a quasi-government entity. So there are many of these distinctions. I want to keep it simple. So the best way of remembering it is public sector, private sector, kind of foreign sector, let's say, loosely putting it. Because it's a foreign company, holding is completely foreign. That's the holding. Basis of liability, we've talked about it, limited liability. By shares, everybody knows. By guarantee, do you know what by guarantee means?
If he fails, I am there.
I am there, correct. Understood? No.
Guarantor.
What it means is if, let's say, 10 members form this company by guarantee, in case of failure of that business, in case of insolvency of that business, each of those members' liability is limited to that guarantee amount. So if 10 people form a company by guarantee and the guarantee sum is 1 lakh each, then in case of insolvency, 10 lakhs is the maximum money that they have to shell out. towards all creditors and debts and monies owed and all that. Then of course your basis of number of members. This, it was not there previously. 1956 Act didn't have single person company. Now even one person can have a company. That's a key provision in 2013.
Yes, is a guarantee for anything.
Which one? For
witness.
For?
Yes, a witness. Witness can be treated as a guarantee.
No. No, it is members. See, in your, which I'll come to later, memorandum of association, you will say who the members are, initial members, and then you can issue it. There are few more slides, and I'm sure that will.
In case taking bank loans or something, they ask for a guarantee.
Represented by. So that represented who represents the. Oh no, that is different.
Okay.
No, don't get confused. That is a guarantor who is guaranteeing that debt. He is underwriting. He is like an indemnity for the debt. If the person is unable to discharge the debt, you are there as surety.
Okay, surety.
So this is different, slightly different.
And one more last question. This the second one, why guarantee is more primitive, is it compared to?
Yeah, more primitive in the sense it is not very popular. Let me put it that way. Because in any case, by shares, you are putting in money up front, and it is anyway limited to that liability. There is no additional liability over and above that.
And people refer to this India Inc. INC to the whole corporate world. So what does their
No. That is a generic term used. See, basically.
Right. Does it stand for incorporated?
No. Yeah. Incorporated in the sense it's typically used by journalists. India Inc. said this. India Inc. respond. No, that doesn't mean it's a company.
No, I know
they
that.
collectively referring to the fraternity.
No, right. But INC is there. Does it stand for incorporations? No, I'm not telling legally.
Yeah. See, it is shortened, but you will never incorporate it, but you will never see the dot there.
Understood.
So India Inc. is used as a proper name.
And I googled it also. There is no reference for that. Nobody has explained what
that is
India
because
is.
it has originated from India Incorporated, which means the corporate world
of India, right?
But if it is incorporated, you are supposed to put a dot. First of all, in India, you will not call it India. I mean, if I were to form a company, Kiran Company Limited, that is how I would call it. I would never say India Incorporated, which is a US term.
Okay.
See, many of these are inherited from the US because it's the mecca of capitalism. So if the press there has referred to US Inc.
So incorporated.
India.
Good.
That's all. So, but there it would have originated from incorporated.
And currently the scenario is that investors generally don't pump money into the LLPs in India.
True.
And very rare.
Very rare. True.
So, I mean, and still it has not led to formation of LLCs yet in India. LLCs.
LLCs.
No, not yet.
See,
I have seen a couple of my friends struggling with LLPs.
LLP.
Yeah. And they are fully aware of it, but still they didn't go for private limited.
LLC is, first of all, I put LLC here for a reason, just to prove a point. This is not LLC, because LLC is a US entity. I just brought it in here to explain that LLC is a wire media between partnership and a company. So it tries to take some advantages of partnership. See, in India, our taxation is kind of uniform. There are different ways in which they tax these entities. And that's the reason why there are many ways in which, so if you were to ask me in the US what is the difference between LLC and incorporated or corporation, you will have to look at the state where the incorporation is done. In California, there is no concept of incorporated. There is a concept of Kenware Corporation, Corp. But whereas in Delaware, it might be Kenware Incorporated. So until and unless you go deep, and the differences might be marginal. In one place, taxation might be, there may be no corporate taxes. So, and filings may also be less. In another case, filings may be more. In general, in the US, LLC has fewer filings than a corporation. And even in a corporation, when I say corporation, by default it is a C Corp. Because S Corp has lower filing, reporting conditions, criteria to be met. And on top, it is indirect taxation. So at the corporate level, there is no taxation. It's only at the individual level.
And in India, how difficult or easy to make this LLP to convert it into private limited?
No, those provisions are there, but any conversion of any kind is a bit painful. LLP, people are shying away. Even company secretaries don't recommend LLPs these days because the general perception with an LLP is people think it is a partnership. And in a partnership, the biggest advantage is the flexibility. Again, if you look back at that slide, earlier slide, I've said partnership is a flexible organization. But it is not flexible. It is very inflexible. You need to take permissions, names, you don't get names, because not only do they check the register of LLP names, they also check the register of corporate names, company names, private limited company, public limited company. So in terms of money, it costs pretty much the same. So a lot of people, a lot of company secretaries themselves don't recommend LLP. Okay. Oh, power.
And have you heard of any one of these companies? I forgot biggies or the internet ones. One of them is an LLP.
Possible.
No. That was a very recent.
No,
I forgot whether it is piggies.
Meaning one of these Flipkart.
Among them, yeah.
Okay.
Piggy, yeah.
Possible. See, they would have started it. Typically when external investors come in, when venture capitalists come in,
Right.
they will always insist on private limited company, and terms that are favorable to them. I will talk about it when I come to share capital, because there are different ways in which you can structure share capital, and it is good to know because VCs have an affinity towards a certain type of stock that they would like to own. Minimum paid up capital for a private company is 1 lakh. Maximum number of members, it's 200. It has to be a private placement, it can't be a public placement. There are so many of these norms and so many of these rules that even though you are a private company, if you make a private placement, you are supposed to, whatever money you raise as private capital, through private placement, you're supposed to keep it in a separate bank account. You can't touch it. And within 60 days of receiving the money,
Is it okay?
yeah,
The same thing going to projector also.
so it's first one of those classes I talked about Subrat Roy. Subrat Roy's problem is this. See, today, especially under the 2013 Act, the Companies Act of 2013, within 60 days, whatever money you raise through a private placement, you're supposed to keep it in a different bank account. Not mix it with the rest of your capital, rest working capital or other business accounts. And within 60 days, you're supposed to issue a share certificate. Failing which, within 15 days of the 60 days, you're supposed to refund the money. Failing which, SEBI will treat it as a public issue and you are in a big suit. Because there is no way you will be able to satisfy SEBI norms as a small private limited company. Because you would have to have a full-fledged company secretary who is fully familiar with public issues and SEBI norms and Companies Act norms and all that.
Unlisted private company, is there any stipulated days after paying the lien? Within how many days?
60 days. Yeah, 60
Even
days.
for the private.
Yeah, private placement is for private limited company. So, if the private limited company fails to do it, under 2013 it gets treated as a public issue, deemed to be a public issue, in which case for every 1 day's delay of, this I am generally saying because you got to check the actual SEBI rules. The penalties could be as high as 1 crore a day. You may have raised some 10 lakhs.
Or else you have to return it, is it?
Within 15 days, you should have already returned.
Within 15 days.
Of not issuing the share certificates within 60 days. And then once you issue the share certificate, within 30 days of that 60-day period, you are supposed to have it registered with the registrar of companies. But that registration with the registrar of companies, you have 9 months. These are all technical, too much of technicalities.
60 days, whatever they give you with interest also.
You're supposed to give with interest if you don't issue the share certificate. Only after issuing the share certificate can you take that money and use it in your business, which normally people don't do. Typical India sab chalta hai. The problem with the New Companies Act is criminal liability is very high. And even if you are an independent director, you can't say I didn't know what was going on. Public company, we talked about it, minimum paid up capital is 5 lakhs. Section 25 is special not-for-profit company under Companies Act. So basically you can be a charitable organization. Although a lot of people use it. In Bombay, in housing societies, it is very common. Because all housing societies are formed as Section 25 companies. So there is no profitable business activity or for-profit business activity, it just comes into being. The advantage is any time the apartment gets sold, membership of the company, they charge a premium. So it keeps appreciating. Membership of the apartment owners. It's basically, you may call it a Section 25 company, but at the end of the day it is nothing but a homeowners association. So that also they sell. Bombay, their business mind. LLC I already mentioned. Actually in this context I should have put LLP and then within brackets said LLC. LLP is somewhere between partnership and a company. Producer company is unique to India. It is basically for the farming community. See, till now farmers, if they have to get together and our farmers are very marginalized. Maximum is 1 acre, 2 acres. So to bring in scientific methods into agriculture, farming, dairy, all those related industries, they have come up with this concept of producer company. So instead of forming a cooperative, you can incorporate it. It's an option to a cooperative.
And in private limited, the minimum paid up capital is 1 lakh. So similarly, you have it in LLP also.
LLP also, I am not sure about the minimum, but it would be around, if not less than this, it would be the same amount. Because I am only saying if not less than 1 lakh, simply because it is somewhere above a partnership but below a limited company, right? So the reason why they conceived the producer company was in a cooperative, regardless of, you can come together, like for example a dairy cooperative. If there are 10 farmers, milkmen who come together, one guy can have 10 cows, another guy can have 100 cows. Because they are all treated as one member. So each member has one vote. Whereas in a producer company, it would be linked to the resources, to the assets that he is putting in. So the voting rights would be accordingly. So they have brought in a concept of company, taken concepts of a cooperative and made it as a producer company. But it is applicable only for people who are in the agricultural sector. Now, formation. See, there are only 4 things needed for, I should actually say maximum of 4 things needed for a company formation. Minimum of 2 things. The one mandatory thing is memorandum of association. The memorandum of association has these 5 clauses: name, registered office. So if a notice has to be sent, which office would it be sent to? Typically the promoter would give his home address or some address, or if he has a company secretary, he would give the company secretary's address to the registered office. Objects clause, this is the most important clause. Anytime you think in terms of forming a company, this is what you need to necessarily look at. Because this gives the details of why the company is being formed. What is the purpose for which the company is being formed? So, make it as complete, as comprehensive as possible. Today, even if you are thinking in terms of, let us say, setting up a company for some clinical work, let's say a lab, like a medical lab, in your objects, you bring into picture all healthcare. Simply because as you grow, you never know which areas you would go into. You would never want the objects to become a restriction on your activity. Because under the Companies Act, if a company engages in an activity that is not listed in the objects clause, it is considered ultra vires of the memorandum and it is supposed to be void. It is an illegal act. Under law, it is an illegal act. Or I won't call it illegal, straight off, unlawful act. Let me put it that. Then liability clause, we know shares guaranteed. You can also have unlimited liability company also.
I didn't get that. Unlimited.
Basically, you are treating it as a partnership.
Okay.
It's unlimited liability. You can have it, but why would it be popular? It would not be popular. I mean, logically, who would want to become a member of such a company where the liability? But on paper it exists.
So otherwise it is by shares, isn't it?
By shares, that is the most popular. Capital clause, which the kinds of capital we will come to a little later because there are different types of shares that a company can issue. See, remember, once the company comes into being, it is the company issuing shares. It is no longer the promoters. Promoters have contributed to promoting the company, and for promoting that company, they have ab initio paid money to buy shares or to own shares of that company that is being formed. But once it is formed, then subsequent issues, it is the company issuing. So value of shares, all that, number of shares issued, all that. Articles of association are basically rules and regulations. This is a must. To form a company, you need to have all this listed. So basically you would call it memorandum of association, but it would have those 5 clauses in great detail. So objects clause, maybe let's say section number 3, but it may have 10 clauses under it. 10 different things that are part of the objects of the company. Okay, so it's all listed there: administrative rules, bylaws, procedures, regulations, how certificates will be issued, rights, transfer, what is the procedure for transferring shares, who is the registrar for shares, all those details will be there. The key difference is, here, this needs the approval of registrar of companies. This is the board. Whatever changes, modifications you need to make there, it would all be through either board of directors meetings or through general meetings, if it is a publicly held company. Voting rights, all that. Then agreement copies with any individual for managing director and whole-time director positions. I mentioned this earlier. This is again an optional thing. If the company upfront does not have an agreement for the managing director, which would talk about terms of employment, like salary, compensation, things like that, you don't need to file it. So this is optional for both the managing director. If you have it, you are expected to include it in your filings when you apply for your registration of the company. But this declaration of compliance is a must. Basically, you are declaring that you are compliant with all provisions of the Companies Act, because it is the Companies Act under which you are forming it. So these two are the only mandatory things. If this is there, you will include it. If this is there, you will include it.
It's a standard format.
Declaration of compliance will be a standard format which the Ministry of Corporate Affairs would have. So So as part, or actually perhaps it will be the registrar of companies, ROC, that will have it.
So as a budding entrepreneurs, they have to work on objects clause.
Objects clause is the one main thing. The more time you devote, the more care you exercise in the drafting of the objects clause, the better off you are. Again, under 1956, objects clause would be broken into main objects and ancillary objects. Basically, ancillary objects are, you have your main objects which talk about the scope of your activities. Ancillary, supplementary objects would be, to perform or to carry out those main objects. There would be certain things that you would need, like buying assets, selling assets, renting property. So these are all things that you will have to do to meet the objects that are there in the MOU. Basically, objects are the purpose for which it is being formed.
The objects, can it be like, I'll say like FMCG, would that be good enough? Because it has all the known operations.
You would have to go into detail. Because what would happen is, even in FMCG, if you say, there may be various companies operating in different ways. So, who would know what an FMCG is? So, you would have to go into details of trading. Is it manufacturing FMCG goods? Or is it trading FMCG goods? Or is it distribution of FMCG goods? Or is it wholesaling of goods? See, there itself there are so many uncertainties, ambiguities. So the objects clause has to be necessarily unambiguous.
But if initially there would be two object classes. If I want to get on expansion, at the time we have to execute another.
It's a headache which is there in one of the next slide, or perhaps the next slide, the one after that. It's a main headache. You would need the approval in certain cases of the registrar of companies, in certain cases of the company law board, in certain cases of the central government. So it's a mess. Name change needs a central government approval. So there are all those hassles which are there. So it's just not worth it.
I think these are time to think.
Okay, so far, so good. This I just put up. We've already discussed this, but this gives you a comparison. We've said memorandum is mandatory. It is supreme for the company. It is like the constitution for the company. Like what constitution is for India, the memorandum of association is for the company. It defines activities. I said it is, acts outside the scope in the memorandum, which is basically the objects clause. They are wide. It also stipulates the basic conditions for the company formation, which is related to the objects clause. Why is it being formed? What are the reasons for it being formed? And what is the nature of business that it will carry out? It gives, essentially, it conveys the character of the company. It's difficult to think. Sometimes it means government approval, company law board, like I mentioned. I've already talked about it. Articles are auxiliary in nature. They are optional. I mean, from a registration standpoint, subsequently you would necessarily need to have articles of association also, but you can do that after formation of or incorporation of the company, and then it just becomes a board resolution adopting it. So you would draft it, circulate it to the board members, and the board members would adopt it. Articles of association. It's not mandatory. It's not a mandatory part of incorporation. That's the key thing. But you're always better off including that also at the time of incorporation. It's about internal regulation and management. Needless to say, since memorandum is supreme, if there is some difference between or conflict between memorandum and articles, it is the memorandum that prevails. It is easier to change rules because these are basically rules internal to the functioning of the company. A special board resolution is good enough. Now comes the process. First, it needs a promoter. Incorporating promoter/promoters. The first thing that a promoter would need is a digital signature. Without that, you can't even start. Very straightforward, there are designated agencies. There is a one-sheet form. You just need your identification, proof of identification and your PAN card. And with that, you will get a digital signature which is pretty much like a pen drive. So anytime, because everything, the whole process, much of the process is online. So anytime you fill out an online form, you need to digitally sign it. Director identification is the next thing. So the digital signature is issued by the Ministry of Corporate Affairs. The director identification number is also issued by the Ministry of Corporate Affairs.
Director's ID.
ID. So every director
As a unique
ID, and there is a reason for it. I think I mentioned it also. 1980, somebody, when they looked at all the companies that had gone public, there were some 1,500 companies, out of which some 850, they did not even exist. The promoters, nobody knows where they are. They've just vanished into thin air, defrauded the investment community by coming out with a public issue, and then they've just vanished. So again, director identification is an online exercise, simple form. You can attach forms, digital forms to it, proof of ID and all that. Only thing is, once you fill it out, the promoter will have to digitally sign it and also get it verified by a full-time practicing chartered accountant or company secretary. So you would necessarily need either a company secretary practicing, not an employee chartered accountant or company secretary. So once that is over, it comes to the name approval. For name approval, again, registrar of companies, you need to give 3, 4, 5, whatever X number of options. There are certain things like the name can't have India, international. There are some of these restrictions. If you want to have international, you can have it, but you would have to pay a premium for it. See, all these restrictions are imposed because they want to ensure that people don't include India and convey to the market the perception, impression that it is a government company. And then, or say international, Kiran International Company Private Limited. So people should not get the impression that it is some foreign US company that has been started here.
So some schools,
It's very common there. There are no restrictions, so they are flouting it. But none of them would have been incorporated as a company. They would all have been formed as trusts.
And these ads also, tele ads and radio ads.
Yeah.
They use India word. I think that should be discouraged. India is, and for everything they emotionally relate.
So the ending, it's pretty obvious. It has to be limited, company limited, so that people know that it is a limited liability company. If it is private, private. If it is public, public. That name, once it is blocked, it should not be similar to existing names. Very logical. Once it is blocked, once the registrar of companies confirms that yes, those names are available, you pay some fee and you block it for 6 months. Within that 6-month period, memorandum, all that you need to submit. 5.
4 names, all 4 names.
In order of preference. If you don't want to give 4, you give 3, but the chances are if all 3 they say it has been taken, it's just that. Nothing stops you. Sometimes, many times what people do is, they informally get it checked. Through connects, through contacts, giving money, all that happens.
And then state names also they want to know.
Which one?
State names.
State names also. So some names are like Karnataka. Why would you want to include Karnataka? Because you are likely, the only reason why you would want to have it in your name is to mislead somebody or the other in business. So that they are very restrictive there.
Or you have to pay some royalty to
Some extra money. Even that.
Mysore Sandal.
Like Mysore Sandal. Yeah. No, but that's a government.
That's a government.
So along with it, you will submit all of the forms and documents which we talked about in the previous slide. Declaration of compliance, memorandum of association, all that. And if there are any contracts with MD, agreement, all that. Registration fee you will have to pay. They will issue the certificate of incorporation. Once this is obtained, the company has come into being. Till then, company has not come into being. So the moment this is issued, if there are 10 promoters or 5 promoters, you have 5 promoters plus 1 entity that has been created. So there are 6 juristic entities. So with that, the income tax department, once you've been issued the certificate of incorporation, will give a PAN for the company and tax deduction so that you can deduct taxes at source.
So the date of birth is what?
Date of incorporation. I mean, basically certificate once, whatever date is on the certificate of incorporation, that is the date of office.
This PAN can be had by an individual?
No, I don't think so, because see, when is it that you would need a TAN? When you are paying somebody something and you are withholding his tax liability on it. So if I am an individual,
possible, but I just want to discuss.
No, I understand.
Professionals can have it. See, you don't have a firm, but still you have a
see,
company.
professionals receive money. So the other person will withhold. That is service tax. That is different.
No, like advocates, we doctors, we have a sort of, even though it is not a firm, if we have a group practice, I think individual can have that.
No, you are a receiver of income. Tax deduction is when you are paying somebody income.
Correct.
And they are withholding it.
Correct.
And
That's in that scenario. As an individual, if I am paying and if I am withholding the tax, I will have to...
You will just pay him because to deduct taxes at source, Income Tax Act comes into picture. And under Income Tax Act, within 30 days of withholding taxes,
You need to
deposit it with the department.
Correct.
If that is the case, it is individual to individual transaction.
Individual.
And if it is individual to individual, how will the department, income tax department, keep track of the money that you are withholding? They would have to get you registered. Otherwise, how will they know that you are a payer of income to people and you are withholding taxes at source? I don't think that process exists. Logically, I will check it out and I will get back, because you are a receiver of income through your fees that you charge.
TIN also, right?
TIN is for service taxes, I think. TIN is employer identification number. TIN is also used in the US. Taxpayer identification number. So don't get confused with that. TAN. TDS, here TIN would be for service taxes. So this is for tax withholding at source. I mean, service tax, whatever taxes you pay, if there is some other department that you need to deposit those taxes with, you would have to be registered.
People used to ask the TIN number when we are charging some service related equipment. So the other finance people, they will ask to share your TIN number.
Okay. See, that is why Benjamin Franklin said there are only 2 things that is definite in this world. One is death, other taxes. There is no escaping taxes. See, this is an extremely critical slide, and this is the last one. Because you need to know, anytime you form a company, you need to be clear about these concepts. There are basically 2 types of share capital. Equity and preference. Again, in equity, it is also known as common shares. Common shares essentially mean that you are treated as a commoner. In the sense, you may have voting rights, but you are given the lowest preference when it comes to liquidation. After all debts are taken care of, after all preference share payments have been taken off, if something is left over, that is meant for the commoners. Common shareholders. But the advantage with common shareholders is they will have voting rights. So they will have a say in appointing the directors to the board. So those advantages they have. There are different ways in which you can package common shares. I don't think this is very common in India, but in the US it is very common. Class A, Class B shares, they will have different. Each type of share will have different bundle of rights. Like Class A may be, for every share that you have of Class A, you will have 10 votes. So each share will be treated as 10 votes. Class B could be each share treated as 1 vote. So accordingly, market will also price it or value it accordingly, differentiate. Because if Class A, if you own Class A share of Berkshire Hathaway, no, I'm getting the name now. Berkshire Hathaway, right? Okay. No, I was for some reason.
Warren Buffett.
Warren Buffett is
Berkshire Hathaway.
Berkshire Hathaway, correct. So we got that right. So Class A shares are always valued higher. Preference shares is what a venture capitalist would typically expect to get out of you, but there are no hard and steadfast rules. This is all subject to negotiations, subject to what his expectations are, his perceptions are, all that. The thing with voting, there are no voting rights, but he may hedge it. Venture capitalists, they have their own ways of taking care of risk. So they may insist on a certain number of positions on the board. Regardless of the money that they are putting in, they may say part of our money will be preference shares, part will be common shares. That common share will give us majority holding in the company and majority voting rights. All these games and dramas they will do. The key thing is to look out, read it very carefully, the term sheet, and not just read the term sheet, read the fine print, read between lines also, because you never know where they have hidden surprises for you. So even in the payment of dividend, it would be preferred. So whatever money gets, and they may impose minimum returns, expectation, minimum, all this they will do. They structure it differently. The only thing that is standard is the non-standard structuring of investments. And repayment of capital, it is preferred because if it's wound up, then they get their money first. Bonus shares are basically shares that are issued by capitalizing reserves. See, anytime you declare a profit after you pay taxes and all that, net earnings, net income, you would want to retain part of that net income and distribute the balance to the shareholders as dividend, right? So over a period of time, that whatever you don't distribute, which is effectively what you are flowing back into the company, that is treated as reserves and you keep separate track of it in your balance sheet, right? You all know it, right? I mean, in finance you would have studied it. So that reserve you will convert as bonus shares and issue. It is like a goodie, it is for managing investor sentiment. That's the only reason. Rights issue is basically nothing but a common share. You are basically offering it to existing shareholders.
So increase of shares,
total shares, your share capital you will be increasing. And often you will be issuing it at a premium. So if the face value is 1 rupee, you may issue it at a premium of 9 rupees. So you may issue, the issue price may be 10 rupees. Authorized capital. This is what, at the time of incorporation, you would, in your memorandum of association, you will put how much that company is authorized to issue shares. So you may have 10 crore shares. You will typically have a very high number. And initially promoting it, you will have 1 crore shares at price, let's say 10 paise per share, right? And that, so that money, which at 10 paise, 1 crore would be 10 lakhs. So you would actually put that money in to promote the company. So that would be the issued share capital. Because out of 10 crores authorized share capital, 1 crore has already been issued at a certain price. The balance is unissued. And it can be issued subsequently. As the company issues that share, additional capital, this goes up, that comes down. Then again in issued share capital, you can have a concept of outstanding shares and treasury shares. Treasury is not common in India, or practically, I don't think it exists in India. In the US it is very common. Outstanding is what has been issued and what has been held by various individuals. Treasury is what the company buys back. And company holds its own stock. Yeah, its own stock it holds. Whenever the company feels the share price, that the price at which the shares are trading in the market is artificially low, and it is holding a huge amount of cash, it will say, let me buy back because it is attractive, it is very low. The true market price should be much higher. So they buy it back and they hold it, and when the prices go up, they sell it also to make money. Again, issued share capital can also be divided into two: subscribed, called up, paid up. Subscribed is when a public issue comes out and I fill out a form and I say, I want 1,000 shares. I have subscribed to pay the money for 1,000 shares. That is subscribed money. And that is how concept of oversubscription comes in. Public issues, you may end up with 10 times oversubscription, 100 times oversubscription, because people are willing to subscribe much more than what the company is willing to give. Called up is what basically gets issued, in the sense, if they allot, I may have subscribed for 1,000 shares, they allot just 100. 100 is what I have been asked, called up to pay. If I have already paid the